The S&P 500 just closed at a fresh all-time high. The Nasdaq is on its longest winning streak since 2009, and yet First Solar dropped 6.4% on the week. Nextracker dropped 5.6%. Even a Chinese export control story that was supposed to rescue U.S. solar could not save them. Let me explain why. Welcome to the Money Mind. Today we are breaking down 3 solar stocks that just put up one of the ugliest relative weeks of the year in a record rally market. First Solar, ticker FSLR, Nextracker, ticker NXT, and Enphase Energy, ticker ENH. Real numbers, real verdict, no hype. Let us start with First Solar. They are the only large-scale thin-film solar panel manufacturer in the United States. Everyone else in the country buys crystalline silicon from China. That one fact is supposed to make First Solar the obvious winner of any U.S.-China solar trade conflict. Friday close, $190.44. Market cap, $20.5 billion. Forward price to earnings ratio, 7.8 times. P/G ratio, 0.49. That is genuinely cheap for a company doing 11% revenue growth, 32% earnings growth, and 32% operating margins. Now here is the part everyone is going to skip. On Friday, Reuters reported that China is considering restricting exports of advanced solar manufacturing equipment to the U.S. That is handed to First Solar. And yet First Solar still closed Friday down 0.6%, while the S&P was up over 1%. More importantly, for the full week, First Solar dropped over 6%. While the market ripped. This is a stock below its 50-day moving average and below its 200-day moving average. A bullish headline did not even hold for a day. That is a warning about sentiment. 29 Wall Street analysts cover First Solar. Consensus price target, $249. That is roughly 30% above Friday's close. The highest street target is $313. 20 out of 29 analysts rate it buy or strong buy. The bull case, they have a real moat, they are cheap on every earnings-based metric, and any actual U.S.-China solar policy lands directly in their lap. The bear case, the stock has been in a confirmed downtrend for months. Tax credit politics can flip again, and a cheap stock can stay cheap for a long time when nobody wants to own it. Next name, Nextracker, ticker NXT. They build solar trackers. Those are the mounts that physically rotate a solar panel to follow the sun during the day. Nextracker has been the #1 global tracker by market share for 10 straight years. Their current backlog is over $5 billion. Friday close, $111.39, up 4.27% on the day. That was one of the sharpest single-day moves in the entire solar sector. But here's the honest part. Zoom out 1 week, and Nextracker was down 5.6% in a market that was up 4.5%. That is a 10-point relative hit in a single week. Friday was a relief bounce, not a new trend. Think of Nextracker as the gym that is having a great Friday workout after a terrible 5-day bender. They are the global leader, yes, but the tape is telling you something. Investors are not yet convinced. A Chinese tools restriction is real policy, and the solar sector has been a political football for 2 years straight. 26 analysts cover Nextracker. Mean price target, $125, about 12% above Friday's close. 21 out of 26 are buy or strong buy. Bull case, they are the #1 player. Revenue is growing 34% year over year. Operating margins are 19%, and US-based assembly suddenly looks like a moat instead of a cost problem. Bear case, at 23 times forward earnings, you're not getting it cheap. The hardware CapEx cycle is still cyclical, and at 5.5% down on the week, the chart is not exactly your friend. Third name, Enphase Energy, ticker ENPH. They make the microinverters that convert the direct current from solar panels into the alternating current your home actually uses. They have about 55% of the U.S. microinverter market. Friday close, $32.48, up 1.6%. And here is the surprise. On the full week, Enphase was actually up 4%, roughly in line with the S&P. That made it the only one of these 3 names to not get run over this week. But do not mistake that for strength. Here is the asterisk. Enphase revenue is down more than 10% year over year. Operating margin is only 6.3%. Earnings dropped 36%. The stock sits near the lower end of its 52-week range, below both its 50-day and 200-day averages. Enphase held in better this week because expectations are already on the floor. That is a very different situation than First Solar or Nextracker, which investors were previously valuing for growth. 28 analysts cover Enphase. Mean price target $45.74, which is about 41% above Friday's close. But only 12 out of 28 rate it buy. 16 are on hold, 4 rate it sell or strong sell. Bull case, microinverter share is still 55%. IQ8 grid forming is genuinely ahead of the competition, and if U.S. residential solar demand returns at all, Enphase has the biggest operating leverage in the group. Bear case, residential demand is still soft, margins have compressed, and every quarter of weak revenue chips away at the moat. So the verdict ranked. Number 3, Enphase, genuine moat, but the fundamentals are still repairing. This is a watch, not a buy, until residential volumes actually come back. Number 2, First Solar. Cheapest stock on the list, strongest single catalyst, and the biggest potential upside if China policy actually lands. But right now it is in a downtrend, below both moving averages, and a bullish headline barely moved the stock. The setup is good, the tape is not. Wait for a real break. Number 1, Nextracker. It is not the cheapest name, but it is the one the market rewarded on the actual news. It was still down on the week, but Friday's 4% pop and the buy ratings from over 80% of analysts tell you where the relative strength sits inside this group. Important reminder, this is not financial advice. Always do your own research before investing. If this helped you think about the solar trade more honestly than the headlines, hit the like button and subscribe for more no-fluff stock analysis. I am the Money Mind. Let us keep building.